Everybody, happy Monday. I hope you're doing well. It's good to be back in the swing of things, doing these videos again for everybody. Um, I wanted to get right to it. There's a comment question that came last Friday from Steve Davies, 5231. Thank you, Steve, for taking the time to write. And it was a comment on a video that was titled Choosing Between Price Targets and Holding Periods. And there's a really, really great question comment because there's a little bit of both. Love the backdrop. Thank you. Everyone loves Red Dalmatian. Thank you for the video. This is one thing I struggle with. Why not take profit at a set price? Either at a past high or a pivot point, you can always re-enter the trade if it carries on going up or down. I was 5x up on 6 different indexes, he says, before Christmas. I say indices, you say indexes. Before Christmas, it has since dropped down to 2x and 2 closed out for nothing. I wish I'd taken a profit a few weeks back. As I say, you can always re-enter the trade. Some guidance on how when you move your stop or when you know to take profit would be great. Again, thank you so much for writing in, Steve. I appreciate you even watching the show. Never mind taking time to comment. And so I was thinking about this before I hit the camera on and turned on my damn recording software. So I started to think like, without having gone to a whiteboard, which I can do. I have a tablet with a stylus that I might start using. The only problem is the recording resolution on that is not so great, whereas this is a 4K camera. So imagine you bought something at 20, right? And you had a $1 stop and you have a $3 price target, or you think that's where it can go. I understand where past highs are because that's data we can observe. This will probably outrage many of you, especially if you're in the short-term trading space. To me, a pivot point is almost a phantom boogeyman kind of a thing because it's not something that you can necessarily define. In other words, if I asked 50 different people, really good traders, anyone who showed up in like Market Wizards, right? Name recognized people who you would think have some success, and you asked them what the pivot point was, I believe you'd get 50 different answers. So the pivot point to me shows up in the art part of which trading is an art and a science. So I can't tell you what that point is because I think you could make it to be whatever you want it to be, especially if you're looking at short-term data. Or I don't really look at swing lows or swing highs as swing high being any type of resistance, nor do I look at swing low as being any type of support that you could count on. That's just my flavor. You might feel very strongly and very differently, which makes for good horse races, right? So say you have, now there's 2 types of orders, which I've reviewed here. You have your protective sell stop, which is below at, say, $1. You're risking $1 just to do the math in our heads. Stop orders, when they're elected, become market orders. So you might get filled exactly at 19, might be 1901, might be 1899. That's how those things work. If you set a sell limit above the market, what's implied there is the expression or better, which means I'm going to sell my entire inventory at 23 or better. That's what a limit order means. So to say that in English, in order to move your entire inventory, the thing needs to be 23 bid. If it goes 23 bid, 2301 offered, and then quickly goes down to what, 22.99, with a 23 sell limit, you're not going to get filled until the bid moves up that extra penny, right? That's the classical way to look at it. So that's the one part on the execution, is that if I'm going to try to move inventory, I want to move all of it. I don't use price targets. I guess if I did, I would set an alert, and if it got to 23, I would sell everything at the market, because when it's time to leave the party, everyone's got to go. There's no coffee to take. There's no one for the road. Get out of my house. I want to go to bed. So I would look at that and say, what happens in those instances where you said 5 or 6x here, I believe. Yeah. Oh, you were up 5x on 6 different indexes. So say that's 25 then. To me, at that point, if you were willing to risk $1 at the beginning, when that dollar was coming out of your corpus, right, of your account. There was no unrealized gain there. You could just as easily put your protective stop at 24 when it's trading 25 bid. Do you see what I'm saying? Now, some of you might get into more exotic, you could always do this. Those are all straw man arguments, so I don't need to get into that. There's a million things that you could do when things at 25. You could sell all or part, right? This isn't a class on that. So I just wonder when you're looking, because I've been there, and you've got these big, gigantic gains that you're frozen. You're frozen emotionally or mentally to try to do the right thing. I want to take that back. I don't know what the right thing is for you. What I would do is typically adjust my protective stop up so that if it does reverse down, I have a type of forced objectivity that doesn't allow me to negotiate. It says I'm making a commitment to protect my capital. Because as that money is represented in my account by virtue of the fact that I have an asset that's up, what is that, 25%? From 20 to 25 is what, 5 over 20, 1/4. So I'm up 25% on that particular risk unit, especially if it's moving the needle on my account, right? Like I don't want to be up a lot in my account and then watch it all come back down because I was afraid to take the gains, or I was reticent to put in my stops because I thought the thing was going to keep going to be a 10x. That's a feeling I would suggest that you invite into your emotional constitution. Because if you just, and I've said this in other videos, if you just set yourself up where you're going to lift everything at 3x, you'll never have the joy or the emotional conditioning that you need when you go through trading to invite bigger gains to your trading, because everything's going to be cauterized. Now, I don't know or not whether, something going 5x to 2x, say to 22 in our example, because the x was 1, we were risking $1. We were up 5x to 25. Then there were a couple that came all the way back. It seems like there might have been a hesitancy, dare I say reluctance, because I don't know you, right? So I can't pass judgment, to adjust your stops, because people don't want to get knocked out of those trades. At least that's definitely a feeling that's prevalent. So to me, again, you could always get in. I think what you said there was a true statement. I just tend to prefer to let the thing run for as long as possible. Again, taking things home over the weekend, overnight, is more my style. I fully understand that once in a while, stops will get run. That's just part of it. I can't lose any sleep over that. It's just the way that it goes. Every once in a while, you're going to get knocked out of a trade for a gain, but less than you wanted to because your stop got hit. But I'm telling you, folks, in thousands of trades, it doesn't happen all that much. And it doesn't happen as much, especially because there's a lot of electronic trading that happens before and after the outcry sessions, both in the futures markets as well as in stocks. So to me, for your size, if this is a retail kind of advice channel, if you will, in many ways, because I think the majority of you are kind of, or at least the majority of you who write in are looking for that type of advice that you would get early on in your career, whereas the folks who are a little more established, their needs are a little different. So the only thing I could say here is move your stop and then don't renegotiate it. This way, if you do have something that goes 3, 4, 5, 6x, whatever it might be, you're always trailing with 1 or maybe 2x of whatever your risk unit is. Going from 1 to 2x is very big. You typically, would mean cutting your position size in half, right? That there's an inverse relationship between what you're risking and your position size. So with your position size staying the same, I wouldn't renegotiate your protective stop. What's a good spot? Well, it's tricky. Depending on your trading style and the time frame that you're looking at, you could look and see, is there any material support, and put your protective stop right around there. I know folks like to say that market makers do this and that. Frankly, I think that's just marketing language for them to try to market their system as if somehow they know a better way. But you have to understand that the minute you put a stop or a limit on the books, Either a specialist is going to see it in New York or it's going to be showing up on a level 2. So there's no way to hide or disguise it. There's no special rule around that. So you have to put in your protective orders to protect your cash one way or another. And when you say you wish you'd taken profit a few weeks back, the best thing to do is set up a rule that you can stick to and not overthink things, right? Because you had that moment when it was up 5x where for some reason you didn't do anything. And I can only go by what you wrote, right? So I don't know what actually happened. There might be more to the story. But just based on what you wrote, it doesn't seem like you raised your protective stop, right? When do you do that? Well, right away, right? Right away. As soon as the instrument you're long is going up, you can use anything from standard deviation. You could do a dollar amount. You could use a value from based on average true range, which is popular. And don't get stuck. Like if the ATR is in fact a dollar, I wouldn't get hung up, like, because now it's just getting started to move. That doesn't mean like you're up one ATR. That means it's time to take profits. That means the market is amenable to your trading style for that moment in time. And that only triggers you, that doesn't trigger you to offset the winning trade. It just means you adjust your protective stop so that now the unrealized gain, right, isn't going to come out of your original corpus. That's all that means. Like you're starting your account balance for that particular day or period of time. It might help many of you to stop overthinking like what happens when you start making money. Like I said, it's just the beginning, right? So there's nothing to really think about if you're up one ATR other than to adjust your protective stop. You could do it at 1/2 and then raise it, like say you're at $20.50. If you're still following the example, you could clearly raise your protective stop to $19.50. So now if it comes back a full ATR from that current market value, you're only really risking 50 cents of that position, right, to your original starting balance for that trading period. So there's lots of ways to skin the cat. I think a lot of it's going to come down to your own trading style and how do you bang that out that way. So anyway, with what I know from what you said, that's how I would do it, is you have to be proactive. And once you start to see multiples of what your risk was, you absolutely have to jump in and start changing your stops. You could also enter them good till cancel. Then this way, you don't have to worry about it because the orders are already in. The thinking is done for you at that point. There's nothing really to worry about. Don't start looking at minute bars trying to overthink like you can get data at that point either, because you can't. Anyway, I appreciate everybody coming in and watching. Any thoughts or comments, please leave them. I appreciate you all being here. I'll see you tomorrow.